What's up, guys? It's Market Disciple, and thank you for being here for another video. In this video, guys, we're going to talk about Jeremy Siegel and some of the comments that he has made, and we'll just take a quick look at the markets also as well. All right, but before we get started, guys, this is Market Disciple. I would please ask you to subscribe to the channel if you haven't done so already. Hit the notification bell so you don't miss any videos, and also smash that like button. All right, guys, so let's get into it real quick. We're looking at the markets on Google Finance. We see Dow Jones, S&P 500, and the NASDAQ all up. Dow Jones up 1.03%, S&P 500 up 1.24%, and the NASDAQ up 2.07%. The Russell Index 0.75%. All right, so with that, we know that we started off the week, right, a little rough. And today the markets bounced back, right? After a couple of days of losses. Now we have Jeremy Siegel here. The Federal Reserve should be near the end of rate hikes as forward-looking inflation has been stopped, says Wharton professor Jeremy Siegel. Now we know we've had some back-to-back interest rate hikes by the Fed, point 75 75 basis points, right? And we were expecting to have another 75 basis points, possibly, or maybe 50 basis points, possibly next month. So Jeremy Siegel is looking for that to slow down. So let's read here what it says. And again, Jeremy Siegel, he's a professor of finance at the University of Penn. The Federal Reserve is closer to ending its series of rate hikes, Wharton professor Jeremy Siegel told CNBC on Monday. Market investors want the Fed to consider that forward-looking inflation has cooled considerably. Right? So this is what investors want. In other words, investors don't want to see continued rate hikes. Right? They want to see the Fed kind of slow down on these rate hikes. And also, he said a rebound in collapsed productivity should aid in pulling down inflation. All right. So the Federal Reserve's aggressive rate hiking cycle should be wrapping soon, Wharton professor Jeremy Siegel told CNBC on Monday, saying there are signs of significant cooling within the hottest inflationary environment in 40 years. He says, I think the Fed should be near the end of its tightening cycle. I think we're already in an above neutral mode. I know a lot of people think not. Well, I think the neutral rate is somewhere between 1 and 1.5%. We're over 2% right now, said the professor of finance at Wharton School during a segment about markets. The Fed, he says, has got to be looking at the sensitive commodities and housing prices and say, you know what? Yeah, we messed up later on and caused a lot of inflation, but forward-looking inflation has really been stopped. So Jeremy Siegel here is really getting the message out that he wants the Fed to kind of slow down with these interest rate hikes. That's pretty much the message here. And we continue on. The Fed, led by Chairman Jerome Powell, last week issued a rate hike of 75 basis points. The fourth rate increase of 2022 has brought its benchmark interest rate up to a range of 2.25% to 2.5%, aiming the moves toward widespread cooling of prices. The U.S. Consumer Price Index in June rose to 9.1%, the largest 12-month increase since November 1981. All right, then he goes on to talk about home prices. We know that home prices have really increased recently, but now have also fallen. Home prices have been falling. Home production has also fallen, right? So net home prices will decline from peaks set during the frenetic pace of demand in 2020 and 2021. Moody's said in a report published in June. It also said potential home buyers will be sidelined by inflation and mortgage rates that nearly doubled over the past 6 months. So, what the Fed has done in using the tools in their toolbox and hiking up interest rates has worked, has cooled down the housing market where potential home buyers are backing out. Potential home buyers are looking at what mortgage rates might be, and they're not they're not buying, right? So the Fed has done what it set out to do, was to cool the markets. It has been doing that with these interest rate hikes. So Jeremy Siegel is now saying, hey, let's slow down now. Let's slow down the interest rate hikes. All right. So Siegel also said he's puzzled by the drop in U.S. gross domestic product with the collapse in productivity, while the economy has added 2.7 million jobs in the first half of 2022. And possibly good news, he said, if we get a bounce back to a more normal level, that really slows down inflation because higher productivity, less inflation. All right. So Jeremy Siegel is calling for a slowdown in interest rate hikes. This is what the markets want. This is what the markets are asking for. Investors are asking for this. So we'll see what the Fed is going to do, what Jerome Powell will do at the next meeting. All right, guys. So with that, guys, we're keeping a watch on the markets. We're keeping a watch on what the Fed is going to do. And with that, we'll leave you guys. Don't forget, guys, to like the video, smash that like button, and subscribe to the channel. And we are out. Peace.